Welcome to the Techno Fundamental Report for March the 2nd. It is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change. Charles Darwin. You know, when it comes to businesses, you have to have a management team that understands the competition and what's going on in the marketplace. You know, examples such as Eastman Kodak, they refuse to change and go into digital cameras, and they no longer exist. And Warren Buffett said it another way. He goes, only when the tide goes out do you discover who's been swimming naked. So, there's a silver lining with these bear markets, and the silver lining is that there's going to be certain companies that prosper during this period, and you're going to see the opportunity clearer because there's really no competition out there in the marketplace. I thought I wanted to mention here that Warren Buffett calls stock buyback critics economic illiterate. We've been talking about capital allocation here recently, and basically what Buffett is responding to is that there's been a lot of critics out there that are saying that stock buybacks somehow are a bad deal for the economy or bad for the country, which is just not true. Buybacks, as Buffett says, are beneficial to shareholders as they provide lift to per share intrinsic value. So in other words, stock buybacks, when it comes to capital allocation, seems to be something that most companies should consider. Ted Williams wrote a book called The Science of Hitting. And it's interesting because Ted Williams was a famous baseball player, famous for his ability to hit the ball. And the science of hitting, he basically broke down his pitches into a graph so that he could concentrate on only swinging at the good pitches. In other words, the reason he was so successful was he didn't swing at everything. So when it comes to the market, I have here the 200-day moving average on the New York Stock Exchange. Now, this is over the last year. Basically, you can see we've been in a downtrend. So my point is with this is that it's going to be very difficult to get a good pitch when the market is in such of a downtrend. So the key to this is to be patient and wait for the right pitch. Now, the market's been selling off, and I kind of wanted to point out the reason why. Back in January, we had a jobs report that was quite shocking. It was 517,000 jobs when the estimate was for around 132,000. So the January number crushed estimates, and you can see here what's happening to the unemployment rate. I mean, this is, we got down during back in 2019 to this level, but then with with COVID, a major spike. But the problem here has been, again, is that as the economy stays too hot, the Federal Reserve has to continue to raise interest rates. And in fact, the 10-year Treasury actually got above 4% this morning. Now, this is the corporate bond fund we're keeping an eye on, because if you relate to this problem here, you're seeing it here. So this is where that report came out, and you can see that the bonds basically sold off in a very big way. So we need to see stabilization in the bond market. Now, again, on that 200-day moving average, you can see this is what's been happening to the value of this bond fund over the last year. So again, it's in a downtrend. We need to see that turn. Also, just to kind of get things going, we need to see more new highs on the New York Stock Exchange. Just the other day we had 8. The magic number is 60 a day, and we're just not seeing 60 a day. To shorten the presentation, I've kind of cut out a lot of the graphs, but you can see here on the S&P 500, we've rallied. Then we got that big jobs report. We're selling off because interest rates are moving higher. You can see here on the NASDAQ, same thing. We're really hoping that we can hold that 200-day moving average, but more importantly, the 200-day needs to turn up. Now, on the aggression index, still looks okay. We're not in bad shape there. So it kind of looks like maybe the technology stocks have hopefully finally bottomed here as we've gotten this rally here in this ratio. And, it pulled back, held that upper moving average. Now, the other aggression index, which is just simply comparing the NASDAQ to the S&P, you can see much improvement there. Now, on the three economic indicators, again, I want to mention this morning the 10 years above 4%, interest rates are in an uptrend, and that 200-day moving average is basically in an uptrend. Now, oil prices continue to be in a downtrend, actually just moving sideways, but being that 200-day moving average is in a downtrend, it's in a downtrend. Financial stocks continue to look okay, kind of moving sideways with the rest of the market. New lows, kind of picking up a little bit. We had 36 the other day. We want to stay below 40 a day, which we've been doing for an extended period, but we're starting to see the new lows kind of pick up a little bit. Again, things are pulling back. Now, on the stock that we're going to do a fundamental analysis on real briefly here is a company called Allegro Microsystems, which is involved in semiconductor sensors. Now, you can see here that this stock, was pretty much moving sideways here up until the beginning of the year, broke out, got into a nice uptrend. We're starting to stabilize in here with a little bit of consolidation. Keep an eye on this one. If it were to break out above 46 on heavy volume, we actually got a gap up buy signal right here, which was somewhat positive. Now let's look at the numbers real quick. As of the most recent quarter, their operating margin and profit margin is quite acceptable, 17% roughly. Return on equity, 19%, which is excellent because their debt is not real high. Their debt to equity ratio is only 4%. They've got some debt, but they've got a lot of cash and a very healthy current ratio. Also, they have positive cash flow. So this is a solid deal. Revenues jumped 33% in the most recent quarter. Earnings jumped 95%. So they're selling something that everybody wants. Now, the other thing we want to look at is the management team. Now, this is Vineet Nargolwala. I hope I got that right, but he's the CEO of this company. Now, one thing about change, we talked about change at the beginning of the video. You want technology-type people, electrical engineering. He's got his MBA in business administration. Very educated man. It appears he's from India. And what the bottom line here is that he would probably be one that would be an inventor type, where they're constantly looking for new ways to improve their products. So anyway, if you have any questions, give me a call. Thank you very much.